a custodian for IRAs, traditional, Roth, 401, solo 401. And he's going to be talking about how to invest in real estate, self-directed IRAs. We've had our account for over 12 years, and we do plenty of different strategies within our IRAs. And the best part, I don't want to steal your thunder, but what we like to see is we pay taxes on our seed money. And then because we have it in the Roth, we have no taxes to paid on the crop. And so in a nutshell, I'd like to hand it over to Dean Manzetti. And thank you so much for doing this with us on Zoom.
Well, hey, Susan, thank you. Thank you, Tri-County Investors Association, and thank you for inviting me. Been a while, as I was mentioning to Tommy earlier. I think I was out at your place probably around March or April of last year. So glad to be back, and glad to have you invite me and be part of your webinar this evening. So I'm going to go ahead and share my screen here real quick. So just want to make sure everybody can see it here. And we'll go ahead and get started. All righty, there we are. And can everybody see my screen?
Oh, yeah.
Yes.
Excellent, excellent. Well, hey, welcome everyone. I'm Dean Manzetti with Equity Trust. And I'm going to be spending about the next 60 minutes or so with you, going over exactly what we do and talking about IRAs and talking about how to build wealth through self-directed IRAs. Here's what we're going to be covering this evening. And Susan mentioned the Roth. That's one of my more exciting ones that we'll be talking about tonight. But we're going to be talking about, exactly what is a self-directed IRA and how do they work. There are 7 different tax advantage accounts out there, but just due to time constraints, I'm going to only cover 4 of those this evening. The other 3 that I won't cover, we'll talk a little bit about that. I'll briefly touch them, but we've got another webinar coming up here tomorrow and at the end of the month that I'll mention here in a minute that you're more than welcome to join us and go over those 3. But really, the meat and potatoes of our presentation this evening, I'm going to be talking about success stories and case studies. And these are actual clients of ours that I personally have known over the years. And I'm going to share their stories with you, their actual investments and what they did and how they did it and why they did it, because that's what you all want to hear. You want to hear, hey, what are people like me doing? Why are they doing it? How are they doing it? What were their results? Things like that. So I've got several of those cool case studies to share this evening with you. And then towards the end here of our presentation, I'll talk a little bit about Equity Trust, a little bit about who we are. If you're interested in learning more or interested in talking about an account, I've got a pretty special deal here at the end, a pretty sweet deal that we'll talk about, and that's it. And then we'll be finished up. And I'd encourage you to take some notes this evening. Now, I'll be happy to answer any questions, but typically about 95% of the questions that I get are answered throughout my presentation at one point or another. But that's okay. If we've got questions at the end, I'll stick around for as long as I have to. And either Vincent or Susan or whoever, if you've got them there in the chat box, or I don't know how you do it. If you have it in the chat box, you can read them to me, or if you let the people on, they can just ask me. Or if you just happen to think of a question, maybe later this evening, or maybe tomorrow or over the weekend, you say, oh man, I had a question for Dean. I forgot to ask him. I wish I knew the answer. I'll be giving you my contact information here shortly. So you can always contact me at another date, another time if you forget about your question this evening. But as I mentioned, we've got a couple other webinars coming up. And if you're interested, let me know. I'd be happy to send the link. We've got a follow-up on mine today. It's tomorrow at 7 o'clock. And it's a continuation of what I'm going to be talking about tonight. Tonight, I'm going to kind of go over the 101s. Tomorrow, we'll expand a little bit more on what I'm going to talk about this evening. And then at the end of the month, for our more experienced, advanced people, investors out there. We're going to be doing an advanced workshop on May 27th at the end of the month. And they'll be talking about the three that I'm not really going to cover this evening. Those are the business plans, the simple, the SEP, and the solo 401k. And they're going to also get into the Secure Act and the CARES Act a little bit more than I am tonight. They're also going to talk about LLCs and trusts, which I really won't be covering this evening. And they'll go over, a lot of the more advanced techniques too. And that's at the end of the month. But kind of as my thank you to everybody here this evening, if you haven't already done it, I know Vincent was asking everybody if you could just put in the chat box there your name, first name, last name, your email address, and your phone number. I'd like to send everybody this book. Normally, I do my presentations live, and I carry a couple of these books with me. It's a book that our founder, Dick Desich Sr. had written. It's Self-Directed IRAs, Building Retirement Wealth Through Alternative Investing. And I'd give these books away at my live presentations, but obviously I can't do live presentations now. So what I've done, I created a digital download. And for anybody who is on the webinar this evening, these are one of the things I'm going to be giving away for free. So that's why I need that information from you, because I'd love to send this to you, this book. It's about 300 pages. It's got a whole bunch of case studies in there. It's got some retirement calculators in there. And it's got, 40 plus hours of webinars and some additional things that you can download out of the book. And that's kind of our way of saying thank you for taking time out of your busy schedule this evening. So again, if you haven't given that to Vincent, or if you just want to email me directly, I need your first name, your last name, your email address, and your phone number. And then again, there's my email on the bottom for any questions that you may have after this evening, later on in the week. It's d.manzetti@trustetc.com. And I'll give you that again here at the end of our presentation. But let's go ahead and get started. First thing I want to talk about here is you're going to hear me talk a lot about this tonight, compounding interest in the absence of taxation. And what does that mean? Well, you're going to hear me talking about, and actually Susan touched on it briefly, the seed and the crop. You're going to hear me talk about how do you get money from the taxable bucket into the tax deferred or the tax free bucket. And that's what you're going to hear me talk a lot about. That's what we mean by compounding interest in the absence of taxation, paying 0% tax, getting to that 0% tax bracket. But before we get started, because my counsel says so, just a quick disclaimer about Equity Trust. We are not a fiduciary, so I'm not here to give you any tax, legal, or financial advice. We cannot do that. We're known for our education, and that's really what I'm here for. I'm here to answer any questions, not give you any advice, but I'm here to educate you. And that's what we're very well known for in the industry, is our education. I'm here to give you as much education here in the next hour as I possibly can, as far as self-directed IRAs, the do's, the don'ts, how they work, what you can, what you can't do. With that being said, what exactly is a self-directed IRA? Some people know what it is, some people don't. But quite honestly, there really is no such thing as a self-directed IRA. It's something that we in the industry came up with that to differentiate it from a traditional IRA or traditional 401k or whatever you may have out there. But technically, as you can see there, it's the same type of what you already may have somewhere. If you're currently working somewhere, an employee, you have a pension, work in the government, maybe you have a TSP, you have a 401k, 403b, or you just have an IRA with somebody. Those traditional ones, it's with a brokerage firm, and you're investing in your stocks, bonds, and mutual funds, okay? With self-directed IRAs, you're not investing in those things, okay? You're investing in what is called alternative assets, with real estates and notes being two of the biggest ones people do. Self-directed IRAs. Now, a lot of people will tell me, they go, well, Dean, I was told by my friend or my accountant told me you're not allowed to use your IRA to do those types of things. I saw it on Facebook. I read it in the newspaper, what have you, that's against the law. That's illegal. You can't take an IRA and you can't buy these things. Well, you certainly can. And if you go to the IRS website, there's really only about a half a dozen things that you cannot invest in with your self-directed IRAs. And as you can see right there, it's called Publication 590A on the IRS website. You Google that up, Publication 590A. And really about the only thing that you cannot buy with your self-directed IRAs, they fall into the collectibles arena, such as baseball cards, stamps, coins, gems, antiques, rugs, artwork, collectibles, certain types of coins, not all coins, because you can certainly do, some, but also the other two things that you're not allowed to invest in with the self-directed IRAs are alcoholic beverages or an S corporation. Other than that, the IRS pretty much permits you to invest in any type of alternative investment above and beyond those items right there that you can do. So the 7 different types of accounts that I had touched on when we first started, they fall into 3 buckets, as you can see there on the left. We've got our individual accounts on the top and our alternative accounts on the bottom. Those are the 4 I'm going to be covering this evening. We're not really going to get into the small business plans, the 4 in the middle, which are the SEP, the simple, and the solo 401k, or the solo 401k with the Roth solo component. And really the major differences between those 4 and the 2 in the top and the 2 in the bottom is the amount of contributions. The contribution limits are much, much higher in those 4 versus the individual accounts and the alternative accounts. You can get up to $63,000 of contribution into some of those ones in the small business plans, depending, how big the business is, if it's your business, how many employees you have, so forth and so on. So that's the main thing, is the contribution limits. But there are, a lot of complex rules. That's why we don't have time to go over them. John, my other speaker, he'll be covering them a little bit more in detail tomorrow and in great detail at the end of the month on the 27th. But we're going to focus on the individuals, the traditional and the Roth IRA, and the 2 in the bottom, a CISA and an HSA. The HSA, known as a health savings account, and the CISA is a Coverdell Education Savings Account. So those are the ones that we're going to be talking about. And it's funny because Susan had mentioned this earlier, and this is a question that I always ask my group when I'm out there. I'm like, would you rather tax the seed or tax the crop? And some people don't really understand what that means. And a lot of people will say, yeah, I'd rather tax the crop. Well, you'd rather tax the seed, as Susan said, and we're going to show you examples of taxing the seed versus taxing the crop. So taxing the seed is the correct answer, as Susan had mentioned earlier when we started our presentation. But I want to show you here an example here. And as you can see on the left there, what we did, we took an example and we used the same parameters for 2 people. On the left, that individual there did this outside of an IRA. It was a non-IRA investment. The person on the right did it in an IRA/401k, some type of an IRA investment. Now, both started with a principal of $20,000 and over a 20-year time period, as you can see. The average rate of return on these 2 were 12%, and the tax rate during that time period was 25%, okay? So after a 20-year period, the person on the left there had accumulated $112,000. The person on the right had accumulated $192,000. Now, that's a big difference. That's a difference of $80,000. And the reason being, the person that did it outside of the IRA was responsible for paying taxes. And we used the 25% tax rate. So every time they made a profit on their capital gains, they were responsible for 25% tax rate on that money that they made. Hence, that only gave them $112,000. The person on the right, who did it inside of a self-directed plan of some type, had accumulated $192,000. Now, as I mentioned, that's over $80,000. That could have been done 2 ways. It could have been done either tax deferred or tax free. And I'm going to talk about that and show you the differences of doing it that way, tax deferred or tax free, deferred or tax free. But here's a book I'd highly encourage everybody to get. I was turned on to this book a couple of years ago. It's by David McKnight. One of my coworkers had given me this book to read, and I read it. It's on what do you call it, Amazon. It's only about, I think I paid about 12 bucks for it, 12, $13. It's a pretty quick read. Took me about 3 hours to read this book. But David McKnight talks about what I showed you there in that graph right there. He talks about how to take that money from the taxable bucket and get it into the tax-free bucket. And he talks about ways to get yourself living to the point where when you're filing your taxes, you're living under the 0% tax environment. You're paying no taxes on all the money that you're making. So I'd encourage you, spend a few dollars, get that book by David McKnight, The Power of Zero. It's a good read. So let's go ahead and start off first with our traditional IRA. Excuse me, I had to get a quick drink of water there. Now the traditional IRAs, they could be, as you can see there, could be an employee type of plan, a pension, a TSP, 403B, 401k, etc. Could also be a business type of a plan, a simple or a SEP. Now I'm just going to go over the rules here, just some of the basic rules. You may or may not know them. Some did change at the beginning of this year. The maximum out of pocket, depending on your age, that you can put in a traditional IRA, as you can see right there, if you're under the age of 50, it's $6,000. If you're over the age of 50, it's $7,000. Now that hasn't changed in a couple of years. It hasn't gone up since I think about 2017 was the last time it went up, and didn't increase last year. There's such a thing called spousal contribution that you may or may not know of. Number one, you've got to have earned income. Got to have earned income in all of these to be able to open them, but you've got to have earned income. You got to be over 18 years of age. But if you're married under the traditional IRA, both you and your spouse do not have to be working. As long as one of the two of you are working and making earned income, you're both eligible for an IRA and the contribution. So let's say you're 55 and your spouse is 55. You're working, but your wife is not working. Well, you can put in $7,000 for yourself, and your wife can put in $7,000 for herself. So you can get $14,000 into that IRA. Now, there is a thing called required minimum distribution. Remember, we touched on taxing the seed and taxing the crop. Well, eventually, one way or another, the IRS wants their tax money. In the instance of the traditional IRAs, and this has changed. When you reach the age of 72, they force you to start taking distributions. So you have to start taking distributions because they want the tax money. Now that changed with the Secure Act. It used to be 70 and a half. But as of January 1st this year, with people living longer, they upped the age to 72. Also, an advantage that traditional has now, which is very similar to the Roth, prior to January 1st of this year, you were not allowed to invest in a traditional IRA past the age of 70 and a half. Once you reach the age of 70 and a half, you couldn't use it no more. You had to start taking distributions, and you were not able to put money in it or invest with that. They've since done away with that. So now it's the lifetime that you have the IRA, similar to the Roth. So you can continue, as long as you've got it, you can continue to invest with and can continue to put contributions in the traditional IRA above and beyond the age of 70 and a half. Now, this is how the traditional works. As Susan mentioned, taxing the seed and taxing the crop. This is the taxing the crop scenario. On the left there, as you can see, that's your money that you're putting in. Let's say you're putting in $6,000. The money is going in tax deferred because you are getting the tax write-off on the front end. You're not paying any taxes. It is now in your IRA. It's tax exempt. You're making compound returns. Now, when you reach the age of 59 and a half, which is the age that you are allowed to start taking distributions, now you're going to be responsible for paying taxes. So you're now paying the taxes on the crop that you built. All right. And the way it works, as you can see right there, beginning at 59 and a half, you can take the money out. If you take it out prior to 59 and a half, you're going to pay a 10% early withdrawal penalty. But at 59 and a half, all right, depending where you fall, you're going to pay ordinary income tax on that distribution. So for example, let's say you had accumulated $1 million in your traditional IRA over the lifetime. You've reached the age of 59 and a half. You now want to take $100,000 out of that. You are now going to be responsible for, in this instance, we use the 20% effective tax rate. You're going to be responsible for $20,000 in taxes. So as you can see there, that's a pretty big hit because you have not paid taxes on this. Yeah, you got the tax write-off at the beginning, But all that profit that you thought you made over the years, you really didn't make all that much profit. Because think about that, $1 million. If you were to take out that whole $1 million, okay, let's say that you had, you know, 650,000 and you thought you made 350,000 over the lifetime of that thing. You take out your $1 million, you're now going to be hit with a $200,000 tax bill. So that 350,000 profit that you think you made just turned into 150. So that's taxing the crop. All right. Now we're going to talk about taxing the seed. And this is a great account. Susan, I believe, mentioned that she had one. I have actually a couple of these, the Roth IRA. It was came into being in around 1998 by Mr. William Roth, senator from Delaware, as you can see right there. It's only 22 years old. It hasn't been around that long. Now, there are some similarities, but there are some advantages here with the Roth. So with the Roth, and we'll show you here in the upcoming slides, you can do either a transfer or a conversion because there are some rules and regulations I'm going to lay out to show you exactly how these work. The maximum out of pocket, it's the same as a traditional based on your age. Under the age of 56,000, over the age of 57,000. It also has a spousal contribution. You also have to have earned income. But the nice thing about the Roth can continue past the age of 70 and a half, but there are no required minimum distributions. That is a huge advantage to the Roth. So not only can you continue to contribute and invest well beyond the age of 72, where with the traditional IRA at 72, you're forced to take those distributions. You don't have to take any distributions from the Roth. You can let that thing grow and grow and grow until the day that you die, and then end up, passing it on to one of your children or one of your grandchildren, and they will be the beneficiary of all of that tax-free money. So let's talk about a little bit of how this Roth works, okay? As Susan had mentioned, we're taxing the seed in this instance. Now what's happening, let's use that same scenario. I've got my $7,000. I put my $7,000 into my IRA, but I'm responsible for paying the taxes on that $7,000. So what's happening now is on that initial money that you're putting into your Roth IRA, you're paying taxes on the seed. So I will now pay my taxes on the $7,000. My $7,000 will now go into my account. All right, it's now tax exempt with compounding interest, but now it is growing tax-free. Every penny above and beyond that $7,000 that I make for the rest of my life, let's say that $7,000 turns into $1 million like the previous slide, 59 and a half, I take out my $100,000. Guess what I pay in taxes? Zero. Nothing. Nothing. That's right, Vincent. Zero. The big old zero. So I paid that little bit of taxes on the front end, the $7,000, say I paid 20% or whatever. I paid my $1,500, got my taxes out of the way, grew the thing, for 20 years, whatever, up to $1 million bucks. And now I can take that money out tax-free for the rest of my life, and it will never hit my ordinary income, and I'll never pay a cent of taxes on that. Now, a lot of people will say, well, Dean, I've been told by my accountant, by my financial advisor, that I am not allowed to open up a Roth because I make too much money. That is true, and that is not true. So let's go over that a little bit. There's a thing called contribution eligibility MAGI requirements. The MAGI requirements are modified adjusted gross income. And based on how much money that you make, you are not allowed to contribute to a Roth. So for example, if you are a single person and you make up to $124,000, you can put the full contribution. Again, let's say you're 45 years old, you make $124,000, you can put the whole $6,000 in there. If you make between $124,000 and $139,000, you can only do a partial contribution. Unfortunately, if you make over $139,000, you are not allowed as a single person to open up a Roth. Same with a married couple filing. If you are married and you make up to $196,000, you are allowed to contribute to a Roth. If you make between $196,000 and $206,000, you can only do a partial. And if you make over $206,000, you are not allowed to contribute, unfortunately, to a Roth. But guess what? there is a way around that. So as long as you follow these rules and you do it the way that we're going to tell you, this is how a lot of wealthy people have been able to get into the Roth. I know we've all heard of Mitt Romney. Mitt Romney talks a lot about his Roth IRA that he opened many years ago. And believe me, Mitt Romney makes more than $200,000 a year. You know, and he's got over $100 million. He talks about that, how he built it up with the companies that he bought. He's got over $100 million in his Roth IRA. So let's talk about how you do that. It's called a conversion, okay? So this is the way around that based on if you make too much money. So what you do, let's say you've got a traditional IRA, you've got a 401k, you've got a pension, a TSP, you've got something sitting out there. And I talk to a lot of people when I'm doing my live events. I go, yeah, you know, I quit this company. I got a 401k. What are you doing with it? Well, nothing. It's just been sitting there. Or, yeah, I got an IRA. What are you doing with it? Well, nothing. You know, I've had it for years. It's just sitting there, not doing anything with it. Well, now's the time to make a move with it. You do what's called a Roth conversion, okay? You take that IRA, that traditional or the 401k or whatever you have, and you convert it. It's called a back door. You can convert it over into the Roth. Now remember, we talked about the seed and the crop. You're still responsible for paying the taxes on it, but the most important thing is you can get well above and beyond the $6,000 or $7,000 limit, the cash, you know, contribution limit by doing it this way. So in this example, let's say you have an IRA out there with someone, or you have an old 401k, you have $100,000 on it and you want to convert it over to the Roth. Well, you're going to be responsible for the taxes. So in this instance, we use 20% because it's a, you know, an easy number to use. I've got my 100,000 in an old traditional IRA. I want to get it into the Roth, so I'm going to put my 100,000 in there, and I'm going to pay my $20,000, and boom, now I've got my $100,000 to grow into millions of dollars now, and I don't have to worry about taxes. Now, a lot of people say, well, Dean, I can't afford the $20,000 to pay in taxes, so what I'm going to do, I'm going to take that $100,000 and I'm going to put $80,000 in my Roth, and I'm going to take the $20,000 out of my 100 to pay for the taxes. Well, that's fine and dandy. And if somebody told you to do it that way, they didn't really think about the consequences, because two things. Number one, you want to get as much money into that Roth as humanly possible so that money can go to work for you and you can start using that money to make investments, number one. So you want to get, you know, if you have 100, you want to get 100 on there. Number two, if you do it the way that somebody had told you to do it, you're going to put 80 in there and you're going to take the 20 and pay the taxes. Now you're going to get double whammy. Number one, you're taking the money out to 20,000, you're paying the 20,000 tax on it, but you have now created a distribution. You have now taken $20,000 out of that IRA. Guess what? Now you're going to get taxed on that. So by all means, you don't want to do it that way if at all possible. Now, is there another way that you can go about doing this? Yes, you can do it in what's called stages, and a lot of people will do it this way. So same scenario, I've got $100,000 sitting there, but I've got $10,000, so I can afford to pay $10,000 in taxes. So in this scenario, I'm moving $50,000 over. My 20% effective tax rate, that's my $10,000 that I'm paying. That leaves me with $50,000 over there in my traditional or my 401k. And once you start a conversion from that account over to the Roth, you can convert in stages. You can convert as many times as you want, and you can do it for as long as you want. There are no limitations. So if it takes you another 5 years to get that other 50,000 over there, you got to do 10, 10, 10, 10, 10, and 10 and pay the $2,000 every year in the taxes. So be it. So that's just another way that you can do it. You can do the conversion in stages if you cannot afford to do it all in one lump sum because of the tax consequences. So our third account that I want to talk about is our HSA, and I have one of these too, and these are really, really great. This is the only account out there. We like to call it, it's got the triple tax advantage, and I'll explain how that works. But first of all, the HSA is a health savings account. Don't confuse it with an FSA, which a lot of people have. The FSA is a flexible spending account. Those are the accounts that if you don't use the money in it that you have, you lose it. This does not work that way. Okay, with the HSA, number one, it's got to be used with a high deductible health plan, The contribution limits are a little bit different than the other two, as you can see there, and the age requirements are a little bit different. It's 55. If you're under the age of 55, you can contribute 35.50. Over the age of 55, 45.50. Or if you're family under the age of 55, you could do 7,100 or 8,100 for family over 55. Now, the funds have to be used for qualified medical expenses. So the way the HSA works, on the red there where it says health savings account plan, look at this as a savings account. It's really what it is. Number one, you're taking that money, let's say you're putting your 35.50 in there on the front end. You now get that money goes in tax deferred and you get the tax write-off. So number one, you're getting the tax write-off on the front end, just like you do on the traditional IRA. Number two, it goes into a savings account. It's tax deferred because you got the tax write-off. All right, the money now is growing compounding interest. Number three, now when you take the money out, as long as you're using the money for qualified medical expenses, you pay 0% on the money that you take out. So number one, you're putting the money in, you've got the tax write-off, you've got number two, the tax deferred growth in the middle, and number three, you've got the taxation free when you take the money out to use it for your qualified medical expenses. So you're getting the best of all three worlds with the HSA. And our last one we're going to cover is our Coverdale Education Savings Account, known as the CESA. The limit's a little bit smaller, $2,000. The child that you use it for has to be under the age of 18, can be used for K through graduate school. And just like the HSA, the money goes in, you get the tax write-off, it grows tax-free as long as when you take the money out, the money is being used for qualified educational expenses. Now, a couple things you need to be aware of. Number one, let's say your child ends up not using this. They end up going through school, you didn't use it, they go through college, they got a free ride, they didn't use it. They can keep the account up to the age of 30, but at the age of 30, they now have to make distributions and they got to start taking the money out and paying taxes on it. Or what you can do, if you have another child, you can transfer this to another child if they're under the age of 18, or you can transfer it to a grandchild as long as they're under the age of 18, or your child that has it. Let's say your child graduates at 22, gets married at 24, has their own children at 28 years old, they can transfer it to their child as long as they do this before the age of 30, and then they can continue on with it that way. The last thing here is if you have a special needs child, the age of 30 does not qualify for them. So the special needs child, that goes away the age of 30. The special needs child can keep this account, for their educational purposes for as long as they're living. So there is no stop date for the special needs child on that. So those are the four accounts that I wanted to talk about, but now I want to talk about the really cool part tonight. Now, a lot of people will say, well, Dean, holy smokes, that's really great, but how in the world am I going to make any money? Some of those things have small limits. The HSA's $35.50, the Coverdale $2,000 a year. My goodness, I put one in there for my kid for 5 years. It's 10 grand. I grow it to 20 grand. That won't even get my kid through one semester of college. How am I supposed to, grow these things? What do you do? Well, we're going to talk about that now. Now, there's 10 different ways that you can partner these things. And I'm only going to talk about a few of them this evening. I'm not going to talk about all 10, but as you can see there are 10 different ways. You can partner with yourself with non-IRA money. You can partner with other people's accounts. You can partner with your children, with your spouse, with your grandchildren. You can partner with other investors. You can partner with someone's business, or you can partner, you can get a non-recourse loan from an individual for someone's business, or a non-recourse loan from a financial institution. Now, we're not going to talk about those non-recourse loans this evening because they're pretty complex, but John will at the end of the month of exactly how the non-recourse loans work because you cannot go to a regular bank to get a loan to do a deal in a self-directed IRAs. Banks won't do it. It's got to be a special bank that does non-recourse loans and non-recourse loans only, and there's only a handful of them in the United States. But John will cover that more, like I said, at the end of the month, just due to our time constraints. But I'm going to go over some of these other ones with you and show you exactly how people were able to partner, various different ways and grow their IRAs. And this is the first one I want to start with Jan, Gary, and Brittany. And Jan, Gary, and Brittany, they're clients of ours. I know Jan and Gary, and I don't know Brittany. I've never met Brittany, but I know Jan and Gary, met them a couple times. They're from the St. Louis area. They're part of the St. Louis RIA. And what they did the family model. They ended up coming to us, and they ended up opening up 3 Roth accounts, one for Jan, one for Gary, one for Brittany. Brittany was about 13 or so years old at the time when they first did it. But here's their story. They had come to one of our meetings, one of the meetings that I was doing a live presentation like I did at your folks a little over a year ago. And it was in around 2008, 2009. It was right about that time period, right after that time period, during the financial crisis that had hit in 2007, 2008. And unfortunately, Jan and Gary had lost a lot of money. They pretty much lost almost their entire life savings. And Jan is a very seasoned real estate salesperson. And she'd been doing it for many, many years, well over 30 years. So she knows her real estate. But she didn't know about self-directed IRAs. She had heard about it from other people. She had read a little bit about it, and she had came to our meeting, like I'm doing right now, one of our live presentations, and to educate herself. She wanted to learn a little bit more. And then she ended up coming to one of our all-day Saturday workshops. And they actually now, Jan and Gary, they actually come to our workshops now and do presentations, for us as a client. But they heard about self-directed IRAs. They educated themselves. They said, you know what, we want to take control of our financial future. We don't want happening to us happen again and lose all that money. So they came to us with they had about $125,000 left over, but believe me, they lost a boatload of money, pretty much their life savings that they had lost, during that financial crisis. Came to us, opened up an account. The rest is history. They've now topped in, they started in around 2009. So it's been 11 years. So they now have over $2 million in their accounts since they came to us a little over 10 years ago. So I want to show you one of their deals that they did here. This is a deal that they did in 55 Ladue Estates. This was about their 5th deal that they did. And Jan usually does 1 or 2 of these deals a year. They're pretty high-priced, high-profile deals, so she doesn't have to do a lot of them. But a lot of people tell me, again, they'll stop me right here. They'll say, well, Dean, hold on a second. How in the world can a husband and a wife, a spouse with their children, how can they partner with each other on a self-directed IRA? I read, and I've been told by my accountant, I've been told by my lawyer, I've been told by my financial advisor that you cannot do a deal with a disqualified person, and those are disqualified persons. You're not allowed to do that. I says, you're absolutely right. The IRS says that you are not allowed to do that with a disqualified person, meaning anybody up and down the family linear tree. So you can't do it with a spouse. You can't do it with your mother, your father-in-laws, your children. But that's the big thing. If you do it the way the IRS says you can do it, and here's the key word, if you do it proportionately, you can partner with anybody any way that you want, as long as it's done proportionately. And I'm going to get into detail here in this very first deal here we're going to talk about. Again, this was their 5th deal. You can see these percentages up there. When I say proportionately, the money that comes out of the IRAs, the percentage has to be the exact percentage going back into the IRAs. So as you can see, Gary's IRA for this deal had to contribute 55%, Jan's 42%, and Brittany's 3%. And I'm going to give you a breakdown and again, go into detail with the project overview here. They bought this property back in June of 2013. Property was bought for a little over $306,000. Jan's Roth had to contribute 42% of that $306,000. Gary's had to contribute 55%, and Brittany's had to contribute 3%. There's the breakdown. Gary's Roth ended up having to contribute $168,000 into the deal. That was 55%. Jan's had to contribute $125,000, which was 42%, and Brittany's had to contribute $3,000, which was a little over $9,200. Now, there was also $3,000 required as earnest money down. That earnest money down, again, has to follow and be done proportionately. So the EMD for Gary's Roth, 55% of $3,000, that's where you get the $1,650. Jan's Roth, 42% of $3,000 is $1,260. And of course, 3% of $3,000 is $90. That's Brittany's deal that she had to put in the EMD, the $90. Now, renovation costs were $296,000, a little over. Again, has to be done proportionately, 55, 42, and 3. So as you can see there, Gary's Roth had to contribute 55% or $163,000 for the renovation. Jan's Roth had to contribute 42% or $124,000, and Brittany's Roth had to contribute 3% or just under $8,900. Now, the way they did this back in 2013 was a little bit cumbersome. At that point in time, there's a lot of paperwork involved when you're dealing with these self-directed IRAs. It's much different than the deals out there now that you're doing with your normal real estate. It's a lot different because you don't own the properties. Your IRA owns the properties. So number one, there's a lot of paperwork, but number two, it's a little cumbersome because every time a portion of the home got renovated, they had to pay the contractor. So as you can see there, they'd fix a bathroom, and let's say the bathroom came to, $25,000. So now Gary's got to write a check for 55% of that 25. Jan's got to write a check for 42 for that. Brittany's got to write a check. Now they go on to another part of the house, the kitchen, same thing. At the end of the day, as you can see, they ended up having to write 15 checks, 5 out of Gary's to cover the renovation costs, 5 out of Jan's, and 5 out of Brittany's. Again, a little bit cumbersome, but back 7 years ago, that was the way it had to be done. Since then, we've come up with about 2 years ago, something called My Equity. And I'm not sure if Susan uses this feature that we've got. It's our online portal. And now all of our investors, they do everything online. The paperwork is done online. We don't need wet signatures. About 99% of everything and all the transactions are done right online. So you don't have to sit there and write checks. You can set up your vendors or your, the renovator people or whatever. You can just HCH money right to them. You can actually set up all your tenants on My Equity, and they can pay their rents right on My Equity. So you don't have to worry about going to get a check or having to send you a check and you putting it into there. Everything can be done online. And it manages it for you. It shows your investments, your accounts. It gives you transaction histories. It shows you everything. All the paperwork is done here. We actually get a lot of our clients come over from our competitors because a lot of them are still doing it the old-fashioned way. And when you're doing it that old-fashioned way, some of these deals take a little more time than they need to because of paperwork, because they're doing paperwork, they're mailing checks, they're having to pick up checks. That takes time. Time costs money. Now everything is done online at your fingertips. And this is a free service that when you become an account holder of Equity Trust, you get to use our My Equity online portal, and it is mobile friendly. And actually, John, at the end of the month, will be showing a demo of how My Equity works. And if anybody out there is interested in seeing a demo before that, I'll tell you here at the end of my presentation how we can get you set up if you want to have a free consultation, and at the same time, we can actually give you a free demo of My Equity, show you how it works. But it's a pretty cool feature, kind of separates us from our competition out there. But just want to share a couple real quick pictures before and after. As you can see, the properties she buys are Class A properties, are all high-end, fixes them up very, very nice, put in a fully furnished basement, with a bar, bathroom, rec room, living area, all that. That enabled them, as you can see, to get the most money that they can out of the deal. So when they ended up selling this property, you can see the proceeds from the sale were $767,000. And again, here's that word, proportionately, those same percentages have to go back in. So of that sale of $767,000, 55% of that had to go back into Gary's Roth, which was $421,000. 42% of the 767 had to go back into Jan's, which was $322,000, and 3% had to go back into Brittany's of the 767, which was $23,000. But more importantly, as you can see, one deal, one deal that they made in 1 year, their IRAs received $163,000. Gary's 90, Jan's 68, and Brittany's almost $5,000. Tax-free. There's the key. They will not pay 1 cent of income tax, capital gains. They will pay nothing on that $163,000 that they made on that deal. That's a pretty sweet deal. And that's what Susan was talking about at the very beginning, taxing the seed and taxing the crop. You know, they tax the seed at the very beginning, and now every one of these deals, and she does 1 or 2 of these a year. So you can see in, you know, in a 10-year time period, you can get yourself up to $1.5 million, $2 million doing 1 or 2 of these deals a year. And it's all tax-free. And they're both over the age of 59 and a half, so they can certainly take the money out, but they don't need it. They're still working. But the key is, you know, you reach that age of 59 and a half, especially if you're a younger person out there listening, you need to get yourself involved in these Roths and start doing these deals, because by the time you hit that age of 59 and a half, you're going to have yourself some pretty nice wealth accumulated. Now, a lot of people will ask me, well, Dean, let me ask you this. I see that, you know, you explain how the partnering, you know, with the linear family tree works. What about accounts? You know, how many accounts can you have? You know, are you allowed to have more than 1 account? Absolutely. We call that a constellation of accounts or a constellation of wealth, as you can see right there. And we've got one of our longtime clients, Stan. Stan has been with us for well over 20 years, and Stan has accumulated well over a couple of $1 million in his accounts. And I'm not going to get into his story in detail, but when he first came to us, he opened up 1 account. He bought a mobile home, had enough money in the account. You know, he bought it. He started renting it out. He created cash flow, made a little bit of money, bought 2 mobile homes, you know, opened up a 2nd account, a 3rd account. Fast forward to today, he now has 11 accounts. 10 of the accounts are his. 1 of the accounts are his in-laws. His in-laws have a Roth. He's got a traditional and a Roth IRA. He's got the spousal traditional, the spouse IRA. He's got the HSA for himself. He's got the CISA for all of his kids. And he's got the solo 401k with the Roth component for his business. And now what he does with those millions of dollars that he's got accumulated in all of these different accounts of his, he goes out and looks for people looking to do deals, and he gives them the money to do the deals, and then they pay him back, and he puts the money back into his accounts and goes and funds another deal. So yes, you can certainly have more than 1 account open at a time, as certainly we can attest to that Stan has done with us. But I want to share this story. Mark is our Investor of the Year for 2018. Mark's from North Carolina. Mark came to us. He had learned about equity trust from his broker. Mark had been an insurance salesman all of his life, and he retired from the business, and he had some money in a traditional IRA, and what he wanted to do in his retirement, you know, he was learning about real estate, and again, learned about us from his broker, came to one of our meetings, learned a little bit more about equity, learned about self-directed IRAs, and Mark said, you know, this is great. I'm retired. I've got some money in an IRA. I can transfer over, you know, and what I'd like to do, I want to buy a house, but I really don't know how to do that. And then I'd like to fix it up and sell it. But, you know, once I buy it, I don't know how to fix it up or how to get it fixed up. And then if I do get it fixed up, I have no idea what it's worth or how to sell it or what I can even get for it. So again, by educating himself with the help of his broker and going to the meetings every month in North Carolina, the RIA meetings, he ended up doing 2 deals. He ended up transferring his money over to us. Couple $100,000 that he transferred over from his IRA, from his retirement over to Equity Trust, put it in a self-directed IRA. And he ended up his first 2 investments that he made in 2017. They closed in 2018. He made a 41% return on his investment on those first 2 investments. He had 3 more investments in the works in 2018. He closed them all last year. So I want to share those very first 2. This is his first and his second investment. Again, this is from a gentleman who really didn't know anything about real estate. He just educated himself, learned about, you know, self-directed IRAs, how to use them, and then with the help of his broker was able to do these deals. So here's his first deal that he did with the help of his broker. They ended up finding this property. Mark ended up having enough money to buy it. He ended up purchasing the property for $89,000. ended up having $64,000 in rehab. Now, it took him a little while because he bought the property in August of 2017, didn't sell it until, October of 29, or of October of the following year in 2018 is when he ended up selling it. But as you can see there, because there was a lot of work to be done, it had 64,000 in rehab. So he purchased it for 89, did 64,000 in rehab, put it up for sale. And when he ended up selling it 14 months later, he ended up making a sale of $200,000. But more importantly, as you can see, he ended up, this is the guy's first deal that he ever did in about a 14-month time period. He ended up putting $45,000 profit back into his IRA on his first flip that he ever did. Now, a couple before and after pictures there, just wanted to show you this one in particular, because Mark took this picture and he tells the story better than I can do. But if you see on the left there, that was what he walked into. When he first walked into the house, he walked into the kitchen, and the house was built in 1970 and hasn't been touched since 1970. So you're talking 2017 when he bought, so 47 years old. So there's a 47-year-old kitchen. As you can see there, the floor's kind of falling apart. It's all stained. It's peeling. That tile's popping up. It's got the wallpaper. It's got the old type of tiles countertops. I believe that's called Formica, and I think that color was avocado. I don't even know if you can get avocado these days, but he laughed when he saw that. And as you can see on the right there, they did a nice job, a nice rehab. The after picture, they brought it up to the 21st century. But he took this picture because he said, Dean, when I walked into this house, I go, man, I knew it needed some work, but it was like walking back into the time tunnel. And I had to laugh when I saw that picture of that property right there. So nice job he did on that. But this is his second deal. And this happened a few months after his first deal at a meeting. He was at a RIA meeting. And he overheard a couple gentlemen talking, and this was in October of 2017, a few months later, after he'd already, started his first deal that he had going. He heard these gentlemen talking, and they were kind of in a pickle. They were in a bind. They needed money. And so as he introduced himself and he found out what they were trying to do, their project was they were tearing down a house and they were replacing that home with two homes, but they ran out of money. They didn't have any more money. They were financed to the hilt. They couldn't get a loan from anywhere or anyone. So Mark just asked some questions, said, okay, well, when do you plan to, have the house torn down? When you put up the two homes, how long is it going to take? How much money do you need? When you sell it, what are you going to sell it for? What's your profits going to be? When all was said and done, Mark ended up doing a real estate note with these gentlemen. He ended up doing the note for a loan amount of $125,000. He loaned him in October of 2017. They completed the deal, finished the tear down, put up the two homes, sold the homes, ended up making themselves a nice profit on the deal. But more importantly, Mark's redemption on his loan of $125,000 was $199,000. Second deal the guy ever did in his life through his IRA. He made $74,000 profit on his second deal. So look at that, what he did in his first two deals in 2018, 45,000 and 74. This guy who had never done a deal in his life made $119,000 profit on the first two deals that he ever did. In 2018, obviously became our investor of the year, but more importantly, the three deals that he did in 2018, which closed last year in 2019, they were also into the six-figure profit amount. So in a matter of 3 years from when he came to us in 2017 till now, 2020, he's accumulated over $250,000 in the 5 deals that he has done. And my point being, this is a gentleman that came to us, a retired insurance salesman. He knew insurance, he didn't know real estate. So, when I tell people, look at Mark, Mark didn't know anything about anything. He wanted to do it. He saw people having success. He heard about it. And with a little help from people, helping him and a little bit of education and going to the RIA meetings, that's why it's so important to attend these monthly meetings. You get to meet people and network, and, you end up finding people that get deals like this. So that's a pretty cool case study there. I wanted to get into this one. That's another longtime client of ours, Gary and Candace, husband and wife. Want to share a couple of Gary's deals that he did right here. This deal here that Gary did, This was a property that he purchased. As you can see there, the purchase price was $71,500. Again, this is one of the ones, it's got to be done proportionately, because in this deal, number one, Gary was partnering with himself. This was not his first deal, but this was one of his first deals where he didn't have enough money in his Roth at the time to purchase the property outright for the $71,500. So he had to put money out of his pocket into the deal. But what he was trying to accomplish, which he did, and he has done since, he's trying to grow his Roth so future deals can be fully funded 100% out of his Roth, all tax-free. So on this particular deal, as you can see, the purchase is $71,500. He ended up buying the property, putting in $31,125 out of his Roth, $10,375 out of his cash. That was a 25-75 split. The repairs also had to be broken down 75-25. Now, I didn't illustrate it there, but that $30,000, 75% of that had to come out of his Roth, and 25% of those repairs had to come out of cash, out of his pocket. Again, the total investment, $71,500. He ended up selling the property for $116,000, and I think there was about $10,000 that he had in closing costs. So at the end of the day, as you can see right there, he accomplished his goal. Number one, he put $8,600 cash back into his pocket. Yes, he had to pay taxes on it. But number two, the more important thing is he put almost $26,000 back into his Roth. This is how he was able and has been able to grow his Roth to make larger purchases. So that 26 grand profit that he made there went back into his Roth. And that, again, you know, that grew his Roth, and that enabled him to go out and purchase other properties and fully fund them through his Roth, like this next purchase right here. This property right here, he fully funded it. This was several deals down the line, but as you can see there, this is a rental property. He purchased it fully through his Roth. The purchase price was $68,000, came out of his Roth. The cost of improvements were $20,000. Came out of his Roth. So he ended up purchasing the property out of his Roth for $88,000. He has since rented this out. It's been a couple years now. He rents it out for $900 per unit. Now remember, he paid cash for it out of his Roth. He's grossing $1,800 a month as his rent, but he's netting $1,400 cash flow. So think about that. Mailbox money. Every month he's got $1,400 that is going tax-free back into his Roth account that he'll never pay a penny of tax on. So that's about $17,000 a year. He can sit on that and continue to get the $1,400 a month, or, and he hasn't done it yet, he can turn around and sell the thing. It's got an ARV of 135 to 145. So he could turn around and make about a quick $50,000 profit on this deal. With his initial 88, make it 90, sell it, make 50. There's 140 that he just put back into his Roth, all tax-free, to go on and do another deal. So as you can see, that's how these investors are doing these deals, with some creative deal making to grow their accounts. Now, here's the last one I'm going to go over. This one's a little bit different. Excuse me, had to get a drink. Get some of my water. This is my partner, John Bowens, and John will be speaking tomorrow and at the end of the month. This is what's called a joint venture agreement. Now, on joint venture agreements, very important. Number one, they can be split up any which way that you want. There's no proportion that has to be done here on a joint venture agreement. With that being said, now you have to be careful. You cannot work with a disqualified person. So you cannot do this deal with your spouse, your kid, you know, with, you know, people up and down the linear tree. This has to be with people that, I don't want to say people you don't know. This cannot be done with anybody, family members up and down the linear tree. It has to be non-family members, the JV. And the reason being is because you're splitting the deal up any which way that you want to. So let me explain how a JV works, okay? What John does, okay, John puts a minimal amount of investment into the property. John goes out, he finds a property, he cuts the deal, he puts a minimal amount of money in it, but John does all of the work, not the physical work, because you're not allowed to do that. You're not allowed to swing the hammer in any of these deals. But what I mean by that is John goes out, finds the property, gets the deal, finds the rehabber, gets the property rehab, handles all the paperwork, puts it up for sale, sells the property, and then splits the profits accordingly. So John's the bird dog, so to speak. And John's got investors or purchasers that he works with in these deals, and he's got a rehabber that he works with in these deals. So here's one of the last deals that he just did. This is his actual deal that we took a snapshot of here on a piece of paper that he wrote out. He found this property. The purchase price of the property was $37,500. There was $10,000 in rehab done to the property. When all was said and done, they ended up selling the property for $97,500. There was $7,500 in closing costs. He ended up netting $90,000 or grossing $90,000 minus the initial purchase price of $47,500. That gave him a profit of $42,500. This is how the profit in the deal was constructed. 3 people involved. You had John, you had Joe, and you had Frank. John, my partner, he invested out of his Roth $2,000. Joe, his investor slash purchaser who actually purchased the property with John, Joe invested the $45,500. So Joe's $45,500 and John's $2,000. There's the $47,500 that it cost for the property to purchase and do the rehab. Okay. When all was said and done, they ended up, as I said, they made $42,500, and the way that they split it 3 ways. After they sold that property, the profit of $42,500, they ended up giving Frank the rehab an additional $5,000 for being the third party in the deal. Now, Frank, number one, did the rehab, so he got his $10,000 for doing the rehab, but Frank was able to make an extra $5,000 off on the side for being part of the deal, which left them a balance of $37,500, and John and Joe split the $37,500 50-50. So as you can see, John, who invested $2,000, ended up with a return of $18,750, and Joe, who actually purchased the property, ended up with the other $18,750. They split it 50-50, and Frank got his extra $5,000 for being part of the JV agreement. Now, a couple things here. When you do these JV agreements, you got to make sure that you get a lawyer that knows how to draft these up because they are a little tricky, and you want to make sure you got someone that understands self-directed IRAs and knows how to do a JV agreement. Number 2, you can split them up any way that you want. But number 3, a lot of people have questioned me on this, and they say, well, you know, why in the world would Joe want to put up all the money, $45,500, and John put up only $2,000, and they split the profits 50-50? Well, take a look at what Joe got. Remember, Joe didn't do anything. All right, this property sold in less than 3 months. Joe basically gave him a check for $45,500, and 3 months later got his $45,500 back of his investment, and he made $18,750 in a 3-month time period. That's a 41% return on his investment for doing nothing, for doing absolutely nothing. So other than just giving him the money to fund the deal. So I don't know about you, but I would do these deals all day long as an investor. And John does. Several of these JV deals throughout the course of the year, my partner, and he's very good at these JVs. And again, John will explain, actually, he'll even whiteboard some of his deals at the end of the month on our upcoming webinar. But I hope you enjoyed all of those case studies. There's some pretty cool ones. I have a whole bunch more, but obviously don't have time to share them with you. But just wanted to go over here in closing. Let you know if you are interested in talking to us. I'll tell you how you can do that. And if you're interested in getting started, hopefully you are, and you say, yeah, I'd love to open up an account. It's pretty simple to do. You open it, you fund it, you make an investment, and the steps are pretty easy. To open up an account, number 1, you just select what type of an account that you're interested in. And we talked about the different accounts. And this can all be done online. We have our online wizard, so you don't even have to talk to us. You can go right online and fill out all this information and really have an account opened within 24 hours. Just need to know your account type, need a little bit of personal information, as you can see there. But I want to stop everybody right there, because this happens all the time when I'm out at meetings. People say, oh, that's great, Dean, I'm all pumped up. I got a deal. I'm working on a deal right now. It's going to close on Saturday. I want to get this thing, I want to get this property into my deal, into a Roth, and make this money and, sit on it tax-free, when I'm older. Well, the problem is, don't do that, okay? You have to have the account open and the account has to be funded before you can start making any offers or we can start making any deals. Because, number one, if you're going to put cash in, that's fine, 6 or 7, but, it's not going to get you too much of a big deal unless you partner with somebody. But number two, if you have money enough to make a deal sitting in an IRA, a 401k, or what have you, until we get that money funded into account and get it open, we can't do anything. And legally, if that money's coming, obviously it's coming from, a competitor or wherever you're getting it from, could be a T. Rowe Price, Schwab, whoever's, got your holdings. They have up to 6 weeks legally to release those funds. So believe me, we're not going to get those funds in 24 hours. It's going to take some time. So please, please open the account, get it funded, and then start making your offers, okay? And we talked about the different ways that you can do that. You can do a conversion, you can do a rollover from another qualified account, you can do a transfer from an IRA, or you can just do the contribution. We have a minimum. If you just want to get the account open and then figure out how you're going to get that money in there later date, you can do that. You can put $500 in there just to get the thing open, or you can put the 6,000 or 7,000 in there, depending on what your age is. And then the last step is you just identify what your investment is and you let us know. You complete online what's called a DOI. It's a direction of investment. And that just tells us what to do and gives us the details, gives us a description, what it is, how much it costs, where the funds have to go, where the funds are coming from, all that stuff. And that's it. You make your investment. Done deal. And I'll leave that up there for a second. As you can see, there's all different types of deals, all different types of things that you can buy: medical offices, hotels, motels, mobile home parks, which are pretty popular these days, RV parks, land trusts, vacation resorts, townhouses, duplexes, office buildings, apartment buildings, all kinds of options that you can do. So as you can see, it is pretty easy. Number one, open an account. Number two, you fund the account. Number three, you make your investment. So who is Equity Trust? Well, we're the leader in the industry. We have been around since 1974. We started off as a brokerage house, and that's very important to know. I'll get into that in a second. We hold over 28 billion, that's with a B, $28 billion in assets under custody and administration. We were either the first or we were one of the first companies, Mr. Dick Dessage, one of the first individuals to do a self-directed IRA back in 1984. That's when the first self-directed IRA was done. And Dick is pretty sure if he wasn't the first, he was one of the very first in the United States to do a self-directed IRA. Now, we are a custodian, not a fiduciary. We are an IRS approved custodian, and I'll get into that in the next slide. But more importantly, as I mentioned, we started as a brokerage service and we still have that. So our platform, we can do both your traditional and your non-traditional investing. So for example, if you've got mutual funds and stocks and bonds somewhere else and you'd like to do a self-directed IRA, but you're not quite sure what you want to do, and you'd still like to keep some of that money, in the stock market or in mutual funds, we can have all that transferred over onto our platform, and you can keep the same stocks, the same mutual funds, the same everything that you have with our brokerage service of Equity Trust. Then when you decide, okay, I think I'm ready to make a deal, I want to take money out of my traditional IRA and put it into a self-directed Roth, we've got your money. It's a matter of 24 hours of us just transferring the money over to another account for you. So, and it can all be done online too. So that's very important. I'm not going to say that we're one of the only ones out there or the only one, but we're one of the only ones out there that you can do both your traditional investment with us and your non-traditional self-directed IRAs with us. We are headquartered in Westlake, Ohio, which is a suburb of Cleveland, Ohio. We're about 20 miles to the west of Cleveland on Lake Erie. And we do business in all 50 states. So just what is a custodian? Well, whether you choose Equity Trust or someone else, hopefully you pick Equity Trust, but do yourself a favor, do yourself homework and ask a lot of questions. Find out who are they, how are they regulated, who are their principals, what kind of experience do they have, how long have they been doing this for, what are their errors and omissions, what's their financial status, ask them for a financial statement, how are they audited, do they meet the IRS requirements, very, very important. we are overseen by 7 different government agencies. So, they've got their finger on our pulse every week, making sure that we're following all the IRS guidelines. So it's very, very important, because facilitators and administrators out there, they don't have to meet IRS requirements. So they don't really care about you. We have to, we have to meet those requirements as a custodian. We also have the authority to hold your assets, your investments, and your properties, and the authority to write checks, issue wires, and issue funds. The facilitators, administrators do not do that. They make you do it, and this is where errors occur. We also will open and we will administer your account for you. The facilitators don't do that, and some of the administrators do. So and there's a lot of extra steps that is involved with facilitators and administrators. So, when you're talking to somebody, find out, are you guys a facilitator, are you administrator, are you a custodian? And if they are a custodian, ask these questions. Again, you got to do your due diligence. Do your due diligence, find out a little bit about them. That's just, what I want to let you know. But hopefully you'll end up coming to Equity Trust. And with Equity Trust, with our customer service, we get a lot of compliments in our customer service, because when you talk to, they're actually sales executives. When you talk to our sales executives, you're just not talking to, a sales executive, just somebody on the phone. Our people are very, very well trained and very experienced. Our average person has over 5 years. They've done almost 9,000 transactions in their career, with almost 3,000 of those transactions just in real estate and real estate only. So they got a very high level of service and education as far as completing real estate purchases and transactions. So you're going to get a very, very seasoned person that you're working with. I talked a little bit earlier about My Equity, our online platform that obviously is free to use, our portfolio management online. Again, that's free. You open up an account and it's free for you to use. I'd also encourage you to go to our website. It's pretty robust. We just put a couple $1 million into it, and we just re-rolled it out a couple of months ago. At the end of last year, we redid it. It's www.trustetc.com, www.trustetc.com. There's some great information out there. Just hours and hours and hours of education. There's YouTube videos, there's customer testimonials, customer videos, all kinds of client success stories, just a ton of information and resources that you can download for yourself. Again, that's what we're known for, is our education. So I'd encourage you, you get a chance, our price lists are up there. Everything is up there on our website. So I'd encourage you, if you get a chance, to go out and check out our website. So I'm going to get ready here to wrap it up, but a couple things in closing. Number one, if you haven't already emailed me or you haven't given that information to Vincent, please do. Need your first name, your last name, your email, your phone number, because I want to make sure, I'm not sure how many people are on this call tonight, but I want to make sure I get each and every one of you. Number one, this digital download, the self-directed IRAs from our founder, Dick Dessage. I want to make sure I get this book to each one of you. I'm also going to include, I don't have it shown here, but I'm also going to include 2 other pieces of bonus educational material above and beyond this book that I'm going to give you. I'm going to be giving you, it's a guide, and the guide is 100 investment options that you did not know were possible. I'm also going to give you a guide on how to conduct your first self-directed IRA transaction. So all of that for free. That's kind of my way of saying thank you. But again, I need that information from you so I can email that to everybody this evening and tomorrow. Again, just wanted to put a last minute plug in for our 2 webinars. If you're interested, let me know and I'll send you the link. We've got the one coming up tomorrow at 7, which will kind of piggyback on some of the things that I talked about tonight, but it's going to be a little longer. It's going to be about 2.5 hours long. And then at the end of the month, that's John Bowens there, my partner, who does those deals. He'll whiteboard some of his deals. He's going to really get down and dirty with the advanced techniques, talking about the solo 401ks, the simple, the SEPs, get more into the CARES Act and the Secure Act, and I did. And he's also going to be talking about utilizing trusts and LLCs for your investing, and also show you some creative note investing ways too at the end of the month. So I'll be happy to send that link out to anybody. And last, as I close here, if you're interested, and I hope a few of you are out there, I've got some more free things to give away. If you'd like to have a one-on-one consultation with one of my account executives, it's free. The consultation is free. You're under no obligation to anything. It's just a consultation that we'll set up, and we'll talk to you and see what you want to do and see if, you know, we're a right fit for you or not. If you sign up for that free consultation this evening, you request that. Again, I need your name, your number, your phone number, and an email from you. I'm going to send you this book. It's the Ultimate Real Estate Investing Resource Guide. And it's going to be talking about, you know, preparing a strategy with your business, property purchase processes, how to manage property. It's going to talk about, you know, tips to improve your real estate investing business. It's going to give you some sources of funding for your next deals, and give you, you know, some additional strategies to consider out there. It's about 25 pages long. And again, that will be free. It's all you got to do is say, yeah, Dean, I'd love to have a consultation and talk to one of your account executives. Boom, I'll get your name and number. I'll have them contact you to set up an appointment. And in the meantime, I'll send that book to you. I'll send this book to you, along with the other free things that you're going to get anyway. And again, it's d.manzetti for this. You have to email me, d.manzetti@trustetc.com, d.manzetti@trustetc.com. So hopefully some of you will want to have that consultation. I'd encourage you, hey, it's free and you're under no obligation, doesn't cost you anything, and you get a free resource guide. I've read it. It's a really, really good resource guide. A lot of good, you know, hey, what's wrong with education? A lot of good education in there. So that's all I've got. I'll leave this up there because that's got my email on it right there. Again, first name, last name, email, phone number. For anybody that just wants any of the other free stuff and doesn't want the consultation, just get me your information or give it to Vincent. I think he's already got some of that from some of the people earlier. Excellent, Vincent. So yeah, and I'll make sure everybody gets that. And with that being said, that's all I've got for this evening. I think we went a little over an hour. Sorry about that, but I would be glad to answer any questions. I don't see the chat here, so I don't know if Susan or Vincent, if you guys have, people have questions or you see some in your chat box, I'd be happy to answer any questions here that we have.
Yeah, I was taking some notes. And I appreciate it, Dean. It was really, really interesting to see how it all kind of comes together. And Susan and I were talking at the breakfast meeting. It was either last week or the week before, a little bit of how it works. And I had some personal questions. Yeah, so like I'm 26, my girlfriend's 26. We're just getting started. We don't have any IRAs to roll over or anything like that. So we would be starting off with like a $6,000 contribution each. I can use that take out the 20% taxes, so it's $4,500 each or whatever it ends up being.
Right.
I can take that $9,000 between us and use it for an investment, and then the profits would go back into our accounts, of course, 50-50. Now, my question is, how much money can I use? I can only use that $4,500 each and then turn it into $20,000. And then I can take that $20,000 and turn it into 40. Now, how many times can
Correct.
I do that a year? Is there a limit on?
There's a limit. Yes, Vincent, great question. And I have something else to tell you too, how to build it up even quicker. I didn't mention it at the beginning. As far as flips go, okay, you want to do 3 or less flips in the course of a year. There is no written law by the IRS as far as, you know, they don't have a law written that says, you know, it's illegal to do, you know, more than 3. But, you know, we suggest to our investors to keep it at 3 or less. Now, do people do more than 3 out there? Yeah, they do. But, you know, you're kind of crossing the line right there, because then the IRS looks at it as if you're trying to run a business, and that's not the reason. For these self-directed IRAs, you're not running a business with these things to go out and just buy 20 homes and flip them a year. Now, you can do as many buy and holds as you want. There's no restrictions on that. And as far as lending and notes, you can do as much lending and as many notes as you can do. A lot of our investors will do a little bit of each, or a lot of our some of our more seasoned investors, they don't even do the buy and holds or the buy and flips. They did at one point, but they accumulated so much wealth. They're now basically a bank. They're going out and just doing notes, because I was talking to someone the other day and he told me, I don't want the hassle of having tenants. You know, he goes, so I just give people need 50 grand. I'll give them 50 grand and I get back 65,000, 30 days later. So, there's no restrictions on something like that. Now, as far as your contributions, number one, I'd really highly encourage you and your wife there to get involved, being such a young age at 26. But something I didn't mention, because it kind of passed us, but I kind of forgot that with the CARES Act, the April 15th deadline has been expanded to July 15th for taxes. So what does that mean for anybody out there? Well, in your case, Vincent, you've never had an IRA, you've never had a Roth. So what you are eligible to do, since you've never had one, you can put in $6,000 for you this year, $6,000 for your spouse this year, and you can go back and put in an additional $6,000 for you for 2019 and $6,000 for you or for your spouse for 2019. So in essence, you could get $24,000 this year before July 15th into your Roth for you and your spouse. Anybody can do that, as long as you don't have one. Yep. So you can actually double up on it. That's something you're allowed to do.
Yeah, we might have to go ahead and do that. Yeah.
There you go.
Kind of
Hey, at your age, man, I would jump on it. I love when I talk to young people. I always tell them, hey, man, if you can do it, get the money in the Roth, even if it's only a little bit. Just get the darn thing started. Because by the time you reach 45 or 50, you'll be so happy. Trust me. You'll be on one of these slides.
Well, I sure hope so. Yeah, that'd be wonderful. And that's the plan, right? Is if we're out here, if we're making money, how do we put it in an instrument that protects it, right? I don't
That's
want
it.
So, but then the second question I had was, so the profits that we roll back into our IRAs, these are investment accounts. Are they earning interest and compounding? Is that money compounding on itself, or are we only able to add to the pot by what we're putting into it? Or
correct. You're only adding to the pot by what you're putting into it. Yeah. So it's not like a stock where you're making, profits on it. The money that you're making is off of your investments. It's going back into there, and then you're taking that profits from investments and going into another investment and popping it back in there.
Gotcha.
That's how you're growing your wealth. And see, the thing is, doing it this way versus stocks, bonds, and mutual funds, you don't have control over stocks, bonds, mutual funds. Look where they've been the last 2.5 months. I mean, oh my God, it's up, it's down, it's up, it's down, it's up, it's down. You have no control over that stuff. You've got control, especially you folks know real estate. You guys are the real estate experts. I'm no real estate expert. This is what I know, investments. So you got the hard part down. The hard part is, buying the property and either buying and holding it or you do a couple flips a year and you make 50 grand on each one. You make 100 grand a year and you do that for 10 years, you got $1 million. So you've got the control. You've got to control how to build that wealth. So that's the key. That's why these are so cool. And that's why I always tell everybody, nothing wrong with having a traditional IRA or the Roth or, the simple or the separate and the others. But, most people go for the Roth just because of the tax. You pay the seat on the tax on the seat at the beginning, and you reap the benefits down the road when you're older of taking all that money out tax free. We've got clients that are taking out $100,000 and $125,000 every year out of their accounts. They're over 60 years old and they've accumulated a couple $1 million in the course of 15 or 20 years. They're taking, they're retired. They're taking 100 grand a year out of their account. It's never hitting their W-2. They're never paying a penny on it.
Yeah.
That's like making 200 grand.
Exactly. Because you're not having to turn around and give it back.
That's right.
So, cool.
That's right.
Thank you.
Any other questions from anybody do we see out there?
Yeah, Dean, this is Sharon. I have a question. Can you hear me?
I can hear you, Sharon. Absolutely.
So I've been hearing from a couple of friends of mine that their 401k their funds in there have reduced since this coronavirus, the financial crisis has come. And
Yep.
I was wondering if the Roth IRA has that same volatility as the 401k.
Well, yeah. I mean, if you're in a traditional Roth that's investing in stocks, bonds, and mutual funds, yes. But if you're doing it under our environment, as I explained to Vincent, what Vincent wants to do, if your Roth is holding on to properties or notes or rentals, no, it doesn't have that volatility because it's not affected. It's not affected like stocks, bonds, and mutual funds. Again, as I mentioned, that for 401k, unfortunately, a lot of people have lost a lot of money because they've been invested in the stock market, and the stock market kind of took a dive. Well, that doesn't happen with self-directed IRAs because you're not investing in stocks or into the stock market. You're investing in a piece of property. So, or a note, a note that you did somebody, or a loan that you did with somebody. So, no, you don't have to worry about that volatility. Hope that answered that for you.
Oh, yeah, thank you.
You're welcome. Any others?
Dean, this is Susan.
Hey, Susan.
Yep, thank you very much for that presentation. It was wonderful. And that
You're welcome.
last slide on the joint venture really answered some of my questions that I had.
Okay.
Steve and I usually get a check made out to the master in equity for our foreclosure auctions. And one time we had a check for, like, say, $2,500 made out to the master in equity. And we were thinking about buying a property or bidding on a property that was a lot more. And so my question was, can I, being the spouse, partner with his IRA, which said that the asset would be 100% on his? And so you answered my question on that. It's because I was, the linear line.
Right.
Say we have an asset that's currently in Steve's IRA, 100% ownership. With that, we can partner with somebody outside, a non-family member, do a joint venture agreement with them for whatever percentage that we would like. So we can bring them in as a joint venture.
Yes.
Okay, perfect.
Yes.
For that existing asset.
Yep.
Okay.
Yes, you can. Yep. You got it.
That was my major question, and you answered it, and I was like, okay, this is great.
Awesome. Go do it.
Well, Dean, this is Tommy Rogers.
Hey, Tommy.
All these numbers and years you're talking about of people, they are years old. I'm way over. I'm over that limit. I'm 76.
You're still a young man, Tommy.
The young people that I deal with that pump me up, tell me I'm not that old. Yes, I agree to that, and I don't feel it. But is it any advantage at all for me at my age to be able to do these things?
Yeah, yes, especially into the Roth environment. Do you have children or grandchildren?
Yeah, I got 5 kids, 15 grand. Yep.
Holy smokes, 15 grand. Congratulations. Well, what you can do, especially into the Roth environment, you can open that thing up and you can grow that and you can pass that down to your children or your grandchildren, and they can become the recipient of owning that without having to pay the taxes on it. So, they can inherit it from you. And believe it or not, I've got a couple, Kevin and Cynthia, they're from the St. Louis area also, and they've accumulated a couple $1 million into their Roth. And they're well over the age of 60, they're in their mid to later 60s. They've done webinars with me and he told me, I don't need this money to live on, we're pretty wealthy as it is. And I asked him, I says, well, what are your plans to do with your Roth IRA for you and your wife. And he goes, we want to leave a legacy. He goes, we're going to, transfer them down to our grandchildren is what we're going to do, and let them become the beneficiary and the recipient of all that tax-free money. So, I wouldn't say age is a deterrent for you, not at all.
I heard you last year, and I've heard your program presented, and I kept saying, hey, I'm still over that age limit. I'm over that age limit. And I was thinking, just wondering, how could I at that age benefit from that thing? And because the stocks and bonds thing, I had some stocks and banks and lost that this year. Because bigger bank bought out a smaller bank and about $40-something thousand. So that hurt. I could have pulled it out last year full ass and done real well and put it into here, that kind of stuff, and been able to pass it on.
Right.
But,
see, here's the other thing too. You have it sitting out there in a self-directed Roth. Now, even if you don't do any deals, you're not losing money on it because it's not going to move, because it's not invested in the stock market. It's going to sit there, but you're not going to make no money and you're not going to lose no money. You'll make money if you do deals, but if you don't do deals and the stock market crashes, you're not going to lose anything because it's not invested in the stock market.
Right. Yeah.
So, yeah.
Yeah, it hurts whenever you lose stuff like that. You don't have any control over the bank stocks. And I've never been a stock person. My dad had been, but I never had been, and just didn't understand it. Didn't want to understand it, I guess.
Yeah, it's tough. I mean, we remember what happened in 2007, 2008, the financial crisis. And unfortunately, I know a lot of people in the last few months have lost a lot of money, because they had all their money tied up in stocks and bonds. And, unfortunately, we've seen what happened with the stock market, from February to now. It's, it's unfortunate, but again, like you said, you don't have any control over that. And, unfortunately, none of us, can read the future.
Well, thank God I had control of 2006 and 7 or the 7 and 8. I had control of that, and I could have sold everything I owned at a fire sale and still made money. So I felt like I'd done good.
Good.
There was a lot of people that lost their shirt. And,
you betcha.
So it's kind of hard to change from that whenever you know that you're doing something, but you always got to improve on whatever you do. Because if you don't keep up, you'll fall behind.
Right.
And that's what this group has done for me, is to keep me young.
Right.
In the mind to be able to, and I'm willing to learn all the time. So that's our group wants to participate and do things, and to be able to donate their time, because we don't, Susan and Will and David and myself, we donate our time. And there's Felix, he's donating his time, something he knows about, to make this group good for these people. Tracy, a bunch of the people, everybody in our group donates their time.
That's what it's all about. It's great. Excellent. Any others?
Hey, Dean, this is Matthew.
Hey, Matthew.
Hey, so I don't know if I missed this part, but let's say you have a friend who is starting a small business. Would you be able to help invest in the startup of that business?
Yes, as long as you do not have any ownership in that business, correct?
Okay, correct. And so
you yourself personally?
Right.
Yep.
Yeah, I wouldn't have.
So
any
you can
ownership.
invest in that.
Okay, and so would you be able to be a consultant, or somebody who is helping them start it up, as long as you don't have ownership?
As long as you don't have ownership in it, yeah. You'd basically be, you'd be the bank, be giving them investment money, and hopefully it grows and put the profits back in. Yeah, you can do that.
Awesome.
Yep.
That's it. Thank you.
No problem. Any others out there? Or like I said, if go ahead.
This is me again, Tommy
Yeah,
again.
Tommy.
I just want to thank you for what you do. I thank you for coming and sharing with us and that type thing. And maybe the next time that you come, we can go for the after hours thing that was after the hour meeting. Okay.
Hey, you know what, Tommy? I will take you up on that.
Yeah. I mean, it might be chicken wings or whatever, but we
Hey,
can.
chicken wings and a cold one. I'm there.
And these Zoom meetings, that's another part I'm missing, because after this meeting, that's what we normally do. And it might be 8 to 10 of us or 6, 8 of us or whatever. But that's a lot of good time together to be able to just to share more stuff that we've talked about.
Oh no, you're right. You know, hopefully here in the future, I'm sure somewhere down the road we'll get. I don't know if we'll ever get back 100% normal, but you know, hopefully get back to normal. I can get back out on the road, and you know, I'll take you up on that, Tommy.
Okay, and like we were talking about in the beginning, you know, what else? What do you see? Or I mean, I know you talk to a lot of people and a lot of organizations. Can you see what they're thinking that this is going to come? What new stuff are we going to have to go through, or that we're going to have to relearn ourselves or self-teach ourselves of things that we can do to progress?
Boy, you know, Tommy, that's a great question. That's you know that's a really really good question. You know, and everybody, the key word I think that everybody uses is education, Tommy. You know, getting yourself educated, you know, not only with what I do, but, you know, I'm sure you've got other good sponsors or other good suppliers or vendors out there, you know, that can share their expertise with your people. And also the nice thing about, you know, having live meetings with people in the room, it's the networking where, you know, you might have this person over here is an expert at, you know, hard money lending, and this person over here is an expert at flipping. You know, it's getting those people together and, you know, and educating them, you know, and educating them. And you're always looking to learn something new. I've been at this a while. I'm sure you've been at this a while. But I'm always, you know, got an open ear to listen to somebody, to learn something new and something maybe I didn't know, because I don't have all the answers for everything. You know, I always tell everybody, hey, if I'm the smartest person in the room, I'm in the wrong room.
Yeah, we had a young man to call me this afternoon, and he said he'd been into 2 of our meetings on Zoom, one person, one on Zoom. Susan, this was Clarence, and he was telling me that, you know, just the things that he was asking and whatever, just, I mean, like he said, I hadn't said anything yet because I felt like that everybody in that room knew so much more than me, and I didn't do so and so. But then something he opened up to me with of what he had done in a real estate deal, and never knew what he was doing. But was able to help him, that he made a good profit. And that's unusual for a first timer or
Sure.
a third timer sometimes to make that the amount of money he made off of it.
Right.
Lucky with no guidance, no nothing, just listening. And
Right.
and I was just so proud of him or whatever. I told him, I don't want to hurt your feelings, but what did you do with that profit? Yeah. You know, how did you sell the house? You know, you could have saved this amount by, you had 2 real estate agents at different times, real estate agent at different times, 2 of them, and you had to pay that money. You had to pay the closing. So there was another way that you could help other people with that profit and had them still paying you for the next, and he's only 36. And so I said, hey, man, you could be getting mailbox money for the next 20 years.
There you go.
He said, what?
What? He probably said, what's mailbox money?
Yeah. Most of the time, that's stuff that you had to back up to get it out the box. Because sometimes you almost just don't really feel bad that you had to get that. But I don't feel bad about it. I like it. I know where else is going. My wife had told me one time that that I need to bring home more money than I was bringing. And I said, well, baby, I'm going to invest in it. And I said, I am bringing some home. And she said, yeah, but I said, at least 10%, you know. And she said, this ain't the church. I don't know what to do with your money.
Any other questions out there from anybody that we see, Vincent, or anything in the chat?
No, I'm not seeing anything. I know we're certainly interested in opening up one and figuring out how we can get this ball rolling. And
Sure. And like I said, our consultation is free, and you kind of bounce your scenario off of our people, and they'll come back and kind of give you some options, and then say, well, you could do this, you could do this, you could do this, and they'll show you each scenario how it would work. And at the end of the day, at the end of the day, it's up to you.
Yeah, and
to do what you want to do. But again, like I say, if there's anybody still on the webinar here, if you haven't already emailed me, if you happen to think of a question or anybody, like I said, anybody still on there, if you happen to think of a question, tomorrow or next week or next month or whatever, you got my contact information. Feel free to contact me anytime.
Yeah, and I've got everyone's info here, so I'll put it all together on
put that together, email that. I'll make sure I get all this free information out to everybody too. Yep, appreciate that. Good.
Hey Dean, this is Steve, and
Yes,
I just
Steve.
wanted to thank you for all your input and information tonight that you so precisely and concisely put out. Brought back a lot of memories for when we first got started back in 2000, I think somewhere around 2008.
Okay.
I don't know if you know remember any of the names from the folks back then, but the guy that got us started, or that we signed our contracts with, or investment got started with, was, I think his first name was Henry, I believe, and it was Batman. They called him the Batman.
The Batman, okay. Doesn't sound familiar.
No, but we signed up with him. We had 2 Roths and two traditionals, and got started that way. And then shortly after that, they changed the requirements, and we got a tax-free rollover from our traditional into the Roths, and started both our Roths that way. Have brought family members in, as you heard from Matthew here just a second ago.
Right.
And
excellent.
Yep. And we still have questions, and that was the one thing I wanted to bring up, was that whenever we have questions, we just pick up the phone and call.
Oh yeah, our people are great. They're very experienced, and if there's somebody that's got the answer in our building.
Absolutely. Yep. I've actually met with Dick.
Have you? Okay.
Oh yeah. Yep. We actually met, or I did, way back when. I think it was like 2008 or 9. Okay. And had one of the after-hour sessions with him.
Okay.
And so yeah, and we've been through the bad times. You guys have been through some rough times yourselves, so Equity Trust has. And,
yes, yeah. We were going through some growing pains, and we had a little bit of a stretch there, and we're the first to admit it. We had some growing pains and some employee pains and a few other issues, and made some changes, and we got all through that and came out stronger.
Oh, absolutely. And that's why I have no qualms about bringing this up anytime anybody talks about investments and, throwing out the way that we do ours is like, when we invest, it's with our Roths. And, somebody will ask, hey, what are you doing? How's that work? Or whatever, we'll tell them what it is and turn them right over to you guys.
Excellent. Well, Steve, appreciate that. Appreciate
Yep.
that. Thank you very much. We certainly appreciate that. And thank you for being a longtime client also.
Oh, yeah.
Excellent. That about it. Looks like we might be wrapping up there. Vincent?
Yeah, I think so. I think, yeah, that was good though. But just like Susan and Steve and Tommy, we very much appreciate it, and it personally,
No, I appreciate, thank you. And Steve, thank you. Susan, thank you. Tommy, thank you. The Tri-County Investors Association, thank you for having me on. Hopefully the next time I'll be live, and
Oh, yes. And I guess one thing you like about the virtual deal about doing it on Zoom or whatever, that you home already.
That's right. I'm already home.
You didn't have to drive nowhere or fly nowhere, catch a
That's
flight
right.
or wherever. Yep. I flew over to Argentina and Chile this past year and went bird hunting and got to do some missionary work and really enjoyed my trip and had a great time. And the oldest person there got to be top shot. That was me.
See?
I beat my kid, I beat my oldest son and two buddies of his. And
Well, there you go.
I helped got started hunting whenever they were young. At 12, they had them in the yard, in the woods hunting by themselves, and or with the group, with the three of them. And but I beat them, and I've only beat them 3 times since they learned all about the shooting. And above, I have rubbed it in. Help feed the country with birds. Yep, I killed 564 birds. That was a lot of shooting, Bubba. Dearly
That's a lot of
enjoyed it.
shooting.
Yep.
Excellent. Good time.
Yep. So, and that was a long trip home. That's what I was thinking about it when I said, "You're already home." That's a long trip home.
That's right. That's a long flight.
I leave a good time, and then you got, oh Jesus, yep. I think 17 hours, something like that. 16 hours. Yeah.
That's a long day.
Yeah, long day. Yep.
Long day.
Yep. Well, thank you again, and I appreciate it. And if
Well, no
nobody
problem.
else has got anything,
Nope. I think that's it.
call us
Like I
anytime.
said, anyone can email me the consultations. Vincent, I'll look for that email.